For most people, guilty means you did something wrong. But now there's a new type of guilty, an obnoxious acronym that stands for Global Intangible Low Tax Income. Now that sounds like a lot of fun. GILTI was created in Section 951A of the U.S. Tax Code by the 2017 tax reform. It involves incredibly complicated calculations and huge additional compliance burdens starting for tax year 2018. And for certain types of shareholders and foreign corporations, it can dramatically increase taxes. Why was GILTI passed? Wasn't tax reform supposed to make taxes simpler? Tax reform was sold as a simplification of the U.S. tax code. And for U.S. taxpayers with simpler returns, their tax filings did become simpler. However, for those with interests in corporations overseas, compliance got more complicated. The purpose of the law was to discourage something called base erosion. Base erosion is basically profit shifting from something that is U.S. taxable to something that is not taxable by the U.S. GILTI changes the definition of what your tax base is. That could make it larger, thus subject to immediate taxes, as opposed to being something that you could defer and possibly pay later, if at all. Wasn't tax reform supposed to create a territorial tax system? A quasi-unlimited territorial tax system was created by tax reform. Certain active businesses are able to take advantage of this partial territorial tax system. For other businesses who have passive income or are structured differently, well, they can negatively be impacted by this very unhelpful portion of tax reform. The IRS has been real serious about another type of base erosion method, claimed abusive transfer price manipulation. And they've been after this for years. And in a way, GILTI is an expansion of this. Who is affected by GILTI? U.S. shareholders and foreign corporations that have a lot of passive income will be hit the hardest. For instance, if your company has a lot of income from patent royalties that used to be U.S. tax deferrable, GILTI could affect you significantly. What are the GILTI tax rates? GILTI creates no additional tax rates. What it does is it expands the definition of what's taxable. Controlled foreign corporations, CFCs for short, well, their shareholders must now include with their currently taxable subpart F income their share of the CFC's deemed intangible income tax for the year. Now, beware, tax reform actually expanded the CFC definition. There is possible CFC status anytime there is a U.S. shareholder of a foreign corporation inside the related party group. The new law ends prior deferral treatment and subjects U.S. shareholders of CFCs, defined as U.S. persons owning at least 10% of the vote or value of a specified foreign corporation, to current tax on any income more than 10% of the CFC's qualified business asset investment. What this means is that GILTI will hit tech companies, service companies, firms with a high degree of intangible assets pretty hard. Are there ways to lower GILTI taxes? Well, most likely. Think about it. There are two different types of tax treatment depending if shares are owned by a corporation or an individual. Tax reform gives corporate taxpayers significant offsets as well as a lower rate. Additionally, C corporations may reduce GILTI by 50% and receive a credit for up to 80% of foreign income taxes paid or accrued by the CFC. Other strategies involve putting intangible assets into more tax-favored entities and structures that may be located domestic or abroad. If you're worried about your own or your businesses or your client's GILTI tax liability or U.S. international tax compliance in general, don't hesitate to contact us. We are a tax law firm and we have our own built-in accounting and compliance departments. GILTI is guilty of being terrible. I'm kind of disappointed with my fellow Republicans who added this to tax reform. They know better than anyone else the claim that mega businesses don't mind tax compliance burdens so much. In fact, many mega corporations enjoy huge compliance costs as those costs keep out their greatest threat: new innovative businesses that could eat their lunch. These artificial barriers to entry can only help established entrenched interests that are already well represented by lobbyists in Washington. Republicans are supposed to be the party that represents those who are trying to climb to the top. Our party is supposed to believe that growth comes from innovation, and innovation so often comes from small and medium-sized businesses. While tax reform helped small and medium-sized businesses that are strictly domestic, the uncomfortable truth is that tax reform did not help small and medium-sized businesses with global aspirations. I hope you join me in spreading the word. Tax reform needs serious reform. Do you have a particular question about GILTI or other international tax issues? Please leave them in the comments. Trust me, I read every comment. Like this video if you think it helped you, and be sure to subscribe if you haven't already. We're going to have some pretty big updates on a FATCA repeal, and also a new proposal to implement the true territorial tax system that we were once promised. We strive to keep you updated with the most essential tax news. This is Anthony Parent of Parent & Parent, LLP, IRS Medic, and I thank you for watching.